Welcome back to the Daily Crypto Roundup. As always, we're going to walk you through exactly what's been happening in the crypto markets today, why prices moved the way they did, and the biggest stories you actually need to understand, rather than just skim past. Today we're covering major global developments, including Pakistan moving closer to tokenizing billions of dollars in sovereign assets with Binance, India's central bank firing a fresh warning shot at stablecoins, the final sentencing of Kwon in one of crypto's biggest fraud cases, another major crypto scam being shut down in India, a rare solo Bitcoin miner beating the odds, and Gemini securing regulatory approval in the US to expand into prediction markets. We'll also break down exactly why we saw a push higher in prices earlier, followed by a pullback in the last few hours, because that move confused a lot of people. Before we get into prices though, we need to do the XRP giveaway. First of all, congratulations to today's two winners. Andre Legal, you've got 10 XRP, and Up Recordings, you've bagged yourself 5 XRP. We will be replying to your comments to get your addresses. Thank you to everyone for your comments this week and keep them coming. It might just be your turn next week. Now let's move into the market. Starting with prices right now, Bitcoin is trading around $90,000, hovering just above that key psychological level after a volatile few hours. Ethereum is sitting around $3,000, holding its ground despite broader market uncertainty. XRP is trading just over $2, still one of the strongest large-cap performers relative to where it was earlier in the year. Binance Coin is hovering around the $875 mark. Solana is trading at $130 after pulling back from recent highs. Dogecoin is sitting around 14 cents. Cardano is trading around 44 cents. Avalanche is $13. Polkadot is hovering a little above $2. And Litecoin is trading in the low 80s. Those are the prices as we're speaking right now, and they matter because they frame what's happened over the last several hours. So let's talk about the move. Earlier today, we saw a noticeable push higher across Bitcoin and much of the broader market. Then, just a few hours later, that move faded and prices dipped back. This wasn't random, and it wasn't driven by one single headline. The initial rise was driven by a combination of technical and sentiment factors. First, Bitcoin had been trading near short-term support levels, and after several sessions of selling pressure, the market was stretched. When you get into those conditions, it doesn't take much buying to trigger a bounce. We saw short-term traders covering positions, some sidelined capital stepping back in, and volume pickup as Bitcoin pushed back toward resistance. That lifted the entire market with it, especially high beta coins that tend to move more aggressively when Bitcoin catches a bid. At the same time, there was a brief improvement in broader risk sentiment. Equity markets stabilized, and there was a sense that the worst of the immediate selling pressure might be behind us, at least short-term. That combination of a technical bounce and improved risk appetite was enough to push prices higher for a few hours. But here's where it changed. As Bitcoin moved back toward key resistance zones, particularly in the low 90,000 range, sellers stepped back in. This is classic market behavior. When prices rally into resistance without a strong new catalyst, traders who bought lower start locking in profits. You also get algorithmic selling triggered at predefined levels. Once that selling begins, momentum fades quickly. On top of that, the macro backdrop is still mixed. Yes, we've seen rate cuts and easing expectations earlier in the cycle, but markets are now recalibrating what comes next. There's uncertainty about how fast central banks will actually move, and whether economic growth can hold up without reigniting inflation. That uncertainty keeps a lid on risk assets, crypto included. So what we saw today was not panic selling. It was profit-taking and hesitation. Buyers pushed prices up, hit resistance, sellers took control, and the market pulled back into the range. That's why the move looked sharp in both directions over a relatively short period of time. With that context in mind, let's move into the stories, because they help explain the bigger picture of where this market is heading. One of the most important developments today comes out of Pakistan. The Pakistani government has signed a memorandum of understanding with Binance to explore the tokenization of up to $2 billion worth of sovereign assets. We're talking about things like government bonds and potentially other state-backed instruments. This is not a meme story, and it's not speculative fluff. This is a sovereign nation actively exploring how blockchain infrastructure can be integrated into its financial system. Alongside that, Pakistan has given initial regulatory clearances for Binance and HTX to begin the process of becoming licensed exchanges in the country. This is part of a broader push that includes plans for a Virtual Assets Act, the creation of a regulatory authority specifically for digital assets, and eventually the rollout of a central bank digital currency. The key takeaway here is direction. While some countries are still trying to suppress crypto activity, others are moving toward regulated integration. Tokenizing sovereign assets is not about speculation. It's about efficiency, transparency, and access to global capital. If this pilot succeeds, it becomes a blueprint that other emerging markets will study very closely. At the same time, though, not everyone is moving in that direction. In India, the Deputy Governor of the Reserve Bank of India has issued a very blunt warning about stablecoins. According to the central bank, stablecoins pose risks to financial stability, can undermine monetary policy, and do not provide meaningful utility beyond existing fiat systems. This reinforces India's long-standing skeptical stance toward privately issued digital assets. India has been much more supportive of its own central bank digital currency initiatives, while remaining openly hostile to decentralized alternatives. That split is important. It shows the ideological divide playing out globally. Some governments see blockchain as an efficiency layer that should be tightly controlled. Others see value in open networks and private innovation. This tension is not going away, and it will shape regulation for years. Next, we need to talk about one of the biggest legal stories in crypto history reaching its conclusion. But we are going to take a quick break here for a word from our sponsors, so please stay with us.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Terraform Labs co-founder Kwon has been sentenced to 15 years in prison for fraud related to the collapse of Terra USD and the Luna token. This was not a slap on the wrist. The judge described the scheme as generational in scale, wiping out tens of billions of dollars in value and devastating retail and institutional investors alike. This sentence matters for two reasons. First, it sends a clear message that crypto fraud at scale will be prosecuted just as aggressively as traditional financial crime. Second, it closes the book on one of the defining collapses of the last cycle. Terra's failure didn't just hurt investors. It shattered confidence across the entire market and triggered a chain reaction that exposed leverage, poor risk management, and outright fraud elsewhere. The industry is still dealing with the aftershocks of that collapse, and this sentencing is a reminder of why transparency, risk controls, and accountability matter if crypto wants to continue maturing. Staying in India, there was also enforcement action today against a large fake crypto investment racket in Agra. Authorities arrested a key suspect accused of defrauding around 1,500 victims through a fabricated crypto platform. Victims were promised high returns, shown fake dashboards, and encouraged to deposit more funds until the scheme eventually collapsed. Stories like this don't always make headlines in the West, but they matter. They reinforce why education and regulation are necessary, especially in fast-growing markets. Every scam that goes unchecked damages trust and gives critics ammunition. Every scam that gets shut down strengthens the case for responsible adoption. Now let's switch gears to something very different, but equally revealing. A solo Bitcoin miner beat extraordinary odds today by successfully mining a block and earning roughly $285,000 in rewards. In a network dominated by massive industrial mining operations, events like this are statistically rare. Some estimates put the odds at once every several decades for a small independent miner. Why does this matter? Because it highlights the underlying design of Bitcoin. Even as mining becomes more competitive, the network remains permissionless. You don't need approval to participate. You don't need to be a corporation. The odds are long, but the rules are the same for everyone. That principle is central to why Bitcoin continues to attract long-term believers, regardless of short-term price action. Next, let's talk about Gemini. The Winklevoss-founded exchange has received regulatory approval in the United States to operate prediction markets. This allows Gemini to expand beyond spot trading into regulated event-based markets, a space that's attracting increasing interest. Prediction markets sit at the intersection of finance, data, and behavioral economics, and regulators are watching them closely. For Gemini, this is about diversification and legitimacy. For the broader market, it's another sign that regulated crypto businesses are finding ways to expand within existing legal frameworks rather than operating in gray areas. That's important for institutional adoption and long-term stability. Before we go any further, quick reminder on security, because it matters more than ever. If you're holding crypto on exchanges long-term, you are taking counterparty risk, whether you realize it or not. Self-custody remains the gold standard. Using a hardware wallet like Ledger helps ensure that your assets remain under your control, not someone else's balance sheet. The link is always in the description if you want to take that step. Now, stepping back, what do all these stories tell us? They tell us that crypto is no longer a single narrative. It's not just price charts and hype cycles. It's governments experimenting with tokenization, central banks pushing back against private alternatives, courts imposing serious consequences for fraud, law enforcement cracking down on scams, individuals still participating in decentralized systems, and regulated companies expanding their product offerings. That complexity is why we get days like today. Short-term volatility driven by technicals and sentiment, sitting on top of long-term structural shifts that don't always move markets immediately. The rise earlier today wasn't a breakout. The dip afterward wasn't a collapse. It was a market still searching for direction while these larger forces continue to play out. And that's exactly why staying informed matters. Not just about prices, but about policy, adoption, enforcement, and infrastructure. Because those are the things that ultimately determine where this market goes next. As always, drop your thoughts in the comments, especially on which of these stories you think matters most over the next year. Like, follow, and stay safe out there. And as always, we will see you at the top.